Do you have a favorite ETF? I believe every ETF investor probably has that one favorite, the one that just feels a little better than all the others in the portfolio. As a dividend ETF investor, I'm no different. There's one ETF I'm a big fan of, and it makes up a big chunk of my dividend portfolio. It's the Fidelity Global Quality Income ETF. Now, this isn't a high-yield ETF. It's a dividend growth ETF. That means the current dividend yield, averaging around 2.8%, is relatively modest, but it grows at a healthy pace. Right now, this ETF pays me about 1,300 euros a year. Not a huge amount, yet. But my plan is to build up this position considerably over time. Since I don't need to live off my dividends now, but only in 10 or 20 years, this ETF is perfect for me. But that's just my approach. If you'd rather see the largest dividend payouts today instead of waiting for them to grow over time, then a high-yield ETF could be a better fit. In this video, I'll give you 3 reasons why I chose the Fidelity Global Quality Income ETF as a core investment. Just a quick note, this is not financial advice. The following information reflects only my personal opinions and experiences. All right, let's jump straight into the first reason I'm a big fan of this ETF. The ETF only holds quality companies. As an investor, I am an owner of companies. The companies in an ETF belong to me. Of course, only a tiny fraction, but still. So, which companies would you want to own as a dividend investor with a long-term horizon? Ideally, you'd want the best companies in the world, the ones that not only pay dividends and keep increasing them, but also grow their share price over time. The Fidelity Global Quality Income ETF delivers exactly that. The Fidelity ETF selects its stocks from the S&P World All-Cap Index. This index includes companies from developed markets and is, overall, quite similar to the well-known MSCI World Index. From there, the ETF filters out only the best companies based on strict quality criteria. I love how they narrow it down from thousands to just the top few. There are many quality filters at play, but I'll focus on the 3 most interesting for dividend investors. Strong and stable free cash flow margins. Only companies that consistently generate high, stable free cash flow over many years make the cut. After all, only those with sustainable excess cash can pay and grow dividends, even in tough economic times. High return on invested capital, ROIC. The ETF targets companies that use their capital exceptionally efficiently. A strong return on invested capital shows that management can generate above-average profits from the resources they invest, a clear sign of quality. Stable or growing dividend yield. Quality is great, but income matters too. From the huge stock universe, the ETF picks companies with attractive, reliable dividend yields, while avoiding short-term dividend traps. Interestingly, the ETF also tries to maintain the original sector weighting of the parent index. So even after heavy filtering, the sector distribution is almost identical, except now it's only quality companies. When you compare the Fidelity ETF to an MSCI World ETF, the sector and country allocations are nearly identical. Yes, the US dominates here too, over 70%, just like in the MSCI World. But it's just the way it is. A lot of the world's strongest companies are American. Among the top 10 positions are well-known giants like Microsoft, Apple, and Nvidia, names that also dominate the upper ranks of the MSCI World Index. While the MSCI World holds over 1,000 companies, the Fidelity ETF holds just about 250. The difference? These are all quality businesses with stable dividends and healthy share price growth. So, quality companies. That's reason number 1 why I love the Fidelity Global Quality Income ETF. But there are two more reasons, both flowing directly from this ETF's focus on quality companies. Dividend growth and stability. The average annual yield for the Fidelity ETF is about 2.8%. It's considerably higher than the MSCI World's yield, which is under 2%, though still modest compared with high-yield dividend ETFs. The main reason for the relatively low payout ratio is the high share prices of the companies within the ETF. As you can see from this chart, the Fidelity ETF's share price growth has been truly impressive. Unlike a typical dividend ETF, this one delivers exceptionally strong price appreciation. The high-quality companies it holds consistently push the share price higher. And because dividend yield is calculated based on share price, the yield often appears modest. Take Apple and Microsoft. Both have yields under 1% per year, but their dividend growth? Absolutely crazy. It's the same story with many other holdings in this ETF. They're dividend growers, not dividend showers. As a result, the ETF's payouts have grown by almost 8% per year, which is insane. Here's something that really amazes me. Even during the pandemic years of 2020 and 2021, payouts never got cut. Very few ETFs can say that. Now that's the kind of dividend growth and stability I want to see. Yes, payouts dropped suddenly in 2024, but I'm confident they'll get back to normal soon. I'm holding this ETF for the long term, aiming for steady dividend growth and stability. Is dividend growth important? If you're investing long term, absolutely. Let's run a quick example. We'll assume 7% annual dividend growth, a 2.8% starting yield, 100,000 invested, and no reinvesting dividends or buying more shares. Basically, we let the 100,000 do its thing and see how the dividends turn out. Yes, I know, most people don't have 100,000 lying around. But hey, it's just a thought experiment, and I like playing with big numbers. Year 1, 2,800 in dividends. After 10 years, over 5,000. After 20 years, over 10,000. After 30 years, nearly 20,000. The yield on cost almost doubles every 10 years. Your cash flow grows even if you don't reinvest a cent. Sure, 5,000 after 10 years isn't exactly life-changing, I know. You could get that 5,000 in the very first year if you put 100,000 into a high-yield ETF. But we can, and should, push those numbers much higher by buying more ETF shares when prices drop. Now imagine buying during a market correction, when the ETF price drops 30%. Your starting yield jumps from 2.8% to 4%, just from buying at a discount. That's a huge boost to your future cash flow. My plan? Hold this exchange-traded fund for the long run and load up on shares whenever the market dips. If you found my insights useful so far, a quick like and subscribe helps the channel reach more investors like you. Thanks. Now, let's get to the final reason. Excellent total return. Even dividend investors want their capital to grow, because at the end of the day, total return, which includes both dividends and price appreciation, is what really matters. Let's keep it brief here. This ETF has delivered strong total returns. Since inception, it's returned about 10% per year, just a touch behind the MSCI World. Most dividend ETFs fall far behind the MSCI World over the long term, giving up too much growth in the process. Here's a chart comparing the total return of 3 ETFs: the MSCI World, the Fidelity ETF, and Europe's most popular dividend ETF, the Vanguard FTSE All-World High Dividend Yield. The Fidelity ETF nearly matches the performance of the MSCI World, whereas the Vanguard ETF lags significantly behind. Why? Because the Vanguard ETF doesn't select companies based on quality, it simply includes all large and mid-sized firms that pay dividends. The Fidelity ETF takes a different approach. As we discussed earlier, it focuses exclusively on high-quality companies. Plus, its country and sector allocation closely mirrors the MSCI World, which explains the similar performance. And those are my 3 reasons why I love the Fidelity Global Quality Income ETF. Do you already have it in your portfolio? Or are you more of a high-yield fan? Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.